Well, good evening, investors. Welcome to our great big old, and it's not a pumpkin pie, it's humble pie or crow, as we're going to talk about the results of our best small companies for 2022, the results, and make our 2023 selections here tonight. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, also a volunteer for the Better Investing Mid-Michigan chapter. And speaking of the Better Investing Mid-Michigan chapter, I'm joined here by my dear colleague, Ken Kavula, investor extraordinaire and raconteur.
Yeah, raconteur. Hi, everybody. Glad to be with you.
Well, this is a program we've been doing for several years. We'll actually show you the scoreboard here in a minute, but it is our annual reminder. And believe it or not, this actually centers on the January effect, which is now either a November or an October effect. And what happens is basically for tax-related selling, a lot of times the smaller companies, will actually get hammered pretty well in the fourth quarter of a year. And you can get opportunities to pick up a promising company that simply has had its price wrecked for the only reason is tax harvesting. And it just can be a real interesting time of year to be out there looking for opportunities. It was one of George Nicholson's favorite themes. And we like it when George had a theme. And our theme for tonight is basically going to be, Ken, if you're willing, let's try to get back on the pumpkin.
Getting back on the pumpkin. Okay, that's the only way to ride that horse. Okay.
Yeah, because we'll cover it in a minute. We got bucked pretty good this year. All right, here's the standard disclaimer. No investment recommendation is intended. It's particularly true tonight. We're going to be talking about a baker's dozen set of companies and a few others that are thrown in on the side, talking about real companies in real time, basically demonstrating the lessons, principles, methods, and techniques of the modern investment club movement as we interpret it and attempt to deploy it, and as championed by the National Association of Investors, also known as Better Investing. So you're going to hear opinions from us, and we will actually go through a cursory review of these companies. It won't be quite the same thing as we go through for some of the roundtable stocks. We encourage you to attend those sessions, but it'll be similar. Please do your own homework. And if we do own something in our personal portfolio, we'll try to remember to disclose that. Speaking of roundtables, last Tuesday of every month, 8:30 Eastern Time, we get together for a webcast, which is free. You can share it with friends and family. But we typically go through 3, 4, or 5 ideas and the analysis of those ideas. If you want to be added to a reminder list, send an email to nkavula1@comcast.net, and Natalie will take care of you. If you want copies of the slides or if you have follow-up topics or Q&A, our 2 email addresses are right there on the screen, markr@manifestinvesting.com, kkavula1@comcast.net. You are going to see some crowded slides. We encourage you to get copies of the slide deck and take a look at that if you want to do any follow-up. But again, be looking for the big picture. Anything you want to add to that, Ken?
No, let's get started, Mark. This is kind of exciting tonight.
Okay. All right, here's our agenda. Again, we refer to these companies as rabbits, Red October. And the trick-or-treaters is our reminder meme of anytime you go shopping for your Halloween candy for next year, you should probably be nudged to be thinking about, looking for some investable, actionable small companies to study. So we're going to cover basically 3 things. How humiliating the market can be, because we do try to beat the market. And
okay, Mark, I'm gonna stop you. I don't think that you pushed the start broadcast button when we started this broadcast, so I'm going to push it right now.
The broadcast is now starting. All attendees are in listen-only mode.
And folks, we're not going to go through the whole front end again, but for those of you that have been alerting me that they couldn't hear anything, now we're with us, and we're going to do a really pared down version. So welcome to the best small companies This is a special roundtable co-sponsored by the Better Investing Mid-Michigan chapter and Manifest Investing. My name is Ken Kavula. I'm joined by my good buddy, Mark Robertson, and we're going to try to get back on the pumpkin. We've been doing this list now for 6 or 7 years after Forbes decided they were not going to do the list. And recently they've come back and started up their list as well. We think ours, while much smaller in scope, has a lot to recommend, and we hope that you look at ours and also look at all the other lists that are coming out at about the same time. Mark, if you click again, I'm just going to indicate that we do have a rejoinder here. This is an educational demonstration. We're not talking about buying, selling, or holding. We do a regular roundtable on the last Tuesday of every month. Our presenter is myself, Mark Robertson, and the regulars are Cy Lynch and Hugh McManus from Atlanta and Pasadena, respectively. We also have a lot of guests that come on the regular roundtable, and our job there is to just have a good time and give you 4 or 5 great stock picks.
Here's some ideas.
If you'd like to be added to the reminder list, just email nkavula1@comcast.net and she'll walk you through adding your name to the reminder list. If you want copies of tonight's slides, that's Mark's real email address, and he'll be glad to send you copies of the slides. And either one of us would be glad to engage you in questions that you might have about the presentation. We know that tonight's slides are busy. They're meant to be discussion slides. They're meant to kick off a talk about a certain company. We are not studying any of these companies in depth, but rather giving you the idea and asking you to take the bull by the horns and see how far you can get in deciding whether it's a good addition to your portfolio or not. Next slide, please. Our agenda is right here, and I'm going to turn it back to Mark now.
So you're going to tell me I spent all that time talking to myself?
Yes, you did, but that's good. Okay.
I feel so much better now. All right, tonight's agenda pretty straightforward. Again, you guys all know that Halloween is our reminder. If you're out buying Halloween candy, you should be thinking about shopping for some small company opportunities. And we refer to these individually as our red rabbits, and they do multiply, and they are a lot of fun. So we're going to talk about humility in the market for a few minutes, and then go through our performance results, not only for last year, which is a tiny bit painful, but the longer term look also. And then we will go into our best small companies for this year. We actually pared down the list a little bit, so we'll have some fun with that. And chances are we will have a little bit of time left at the end with that pared down list. All right, so here is kind of the summary of the pain that we went through over the last several months. We brought Ed Harris on board to try to get us a good smooth landing with our best small companies for 2022 overtaking the stock market. That didn't happen. And I love the quotes. You got to believe you're Superman to do this, and that you're capable of solving the problem. And then, of course, that tribute to coffee, which Ken knows is a kind of a theological moment for me. Coffee is a good thing that keeps us going. And then this notion of let's work the problem, people, let's not make things worse by guessing. Yeah, it was a little bit rough. And we tried threats, we tried humor, we tried cajoling the small company stocks, and the reward we got for all of that begging and pleading was the best stock market in terms of the index since 1976. And the Russell 2000, the collection of smaller companies, didn't even come close to keeping up, and basically ended up drubbing us in the end. So Ken and I have our bottle of Dead Rabbit on the right there that we could resort to if it becomes necessary. All right, here's basically this summary of how special, and I'm using air quotes, Ken, it was. Notice here the Russell 2000, that's just over the last year. That's since last Halloween. And we basically peaked before Thanksgiving. and it's been all downhill since Thanksgiving last year. And that came from a Barron's article this weekend that Michael Smith sent our way. Some good stuff in there. But we just noticed that over the last, I don't know, what is that, 40, 42, 43 years that the Russell 2000 has been out there, there have been moments. I mean, this was a particularly nasty moment here. And this one actually will live in infamy. It's pretty nasty downdraft in the Russell 2000, which is a collection of the smaller companies. It's an index. Any comments on that, Ken?
Well, only to say, Mark, that I've been doing a lot of thinking, and I'm wondering if the steepness of the curve from about 2000, maybe 12, the steepness of the general curve going upward from maybe 2012 to that high point is balanced by what's happening now. And maybe when we look back on this, we're going to tell ourselves this is nothing more than zero interest rates unraveling themselves. That never seemed natural to me, that interest rates would move to zero and that I would get nothing for keeping my money in money markets or in banks or in bonds or anything like that. But maybe history will name this with something to do with the fact that we tried an experiment to save us from that 2008 abyss, and the experiment seemed to work for a long time, but eventually it had to unravel, and there it is unraveling. Maybe COVID doesn't have as much to do with this as we thought.
Yeah, and I would second that, and also notice that this actually right here, this trajectory right here, which basically was almost straight up, and it could almost put a Roman candle up here exploding.
Yep.
I think we got caught up a little bit in that. Just a little
Well,
bit.
especially with an awful lot of companies that had absolutely no earnings, and as better investors, we should have known better to stay away from them like a hot stove. But I think that many of us dabbled in that kind of stock. I still love the phrase that we've been using in the last year and a half, which is these stocks exhibited a huge price to hope ratio, but that's about the only number that was good in the whole analysis of a lot of those
There were
companies.
definitely a few of those in the mix. There's no doubt about it. I included this one just again. This is not just small company stocks. This is kind of total market thinking, and it comes to us by Ken Fisher, a friend to Better Investing over the years. And I have spent some time with Ken. He's an interesting guy, but he refers to the stock market. I don't know if it was his father or Buffett or Graham or somebody back there referred to the market as the great humiliator, and he kind of adopted that for much of his theme. And this is actually from a few months ago, and he's basically saying that same type of story that we've been talking about on a number of our programs, that we could be in a bear market, we could be in a really nasty correction or whatever, but they do end. And the statement that I really love here, because I think we're in an accumulation zone, you've heard us talk about that. The thing that I like here is you should be finding good stocks and accumulating, because the rebound is always bigger. It never has not been the case. And I think back to, and Ken, you remember this well, back in 2008, we basically had a back up the truck moment around Thanksgiving. And then the stock market was still stuck in the doldrums for another 3 months. Well, were we wrong to accumulate stocks between Thanksgiving and March? I don't think so. And I think
No, Mark, that's some of the best investments I've made in my entire career, in that 3-month period, in that at that point that I've and they formed the basis of my retirement nest egg. The other thing, Mark, I think we need to do is to, with information bombarding us from everywhere, we need to avoid the Cassandra who's screaming that the sky is falling. Maybe it's Chicken Little rather than Cassandra, I don't know. But you get these emails, or you get these news flashes in your news feed, sell everything right now because the sky is falling and you have exactly this many days or this many weeks to do it. I think that's a siren call that's extremely dangerous. And I think that judicious selling for good reasons is always something you should be looking at, but selling just to sell because somebody says that the market's going to be so much worse a month from now or 2 months from now, I think that's just foolish.
All right, so let's go ahead and launch into our results. Again, this is our reminder. And in fact, Ken, I'll let you tell the story about basically where we ended up with those up, straight, and parallels.
Well, when I first met Mark, I had already had a strong interest in small companies. I had always thought that they were undercovered by Better Investing, and I had read all of the material and very carefully tried to follow some of the basic rules of portfolio building, especially early in my investing career. You know, Better Investing has always recommended about 25% of your holdings stay in small companies, and they defined them pretty narrowly. They didn't define them by capitalization. It was defined by sales. And I thought it made sense, but finding those companies was very difficult. The magazine that I was getting seemed to have a bias towards very large companies. The articles that I was reading seemed to have a bias towards very large companies. And so I became very interested in some of these lists that some of the financial magazines were putting out. And I found Forbes, and it was putting out on a yearly basis around Halloween a list called the 100, and some years it was actually 200 best small companies. They weren't claiming they were small cap, they were claiming they were the best small companies. They were limited to about $1 billion in sales, and they were looking for pretty good sales growth, double-digit sales growth, and they were avoiding the penny stocks and the stocks that can get you into real trouble. And so we started to follow them. And that's about the time that I met Mark and talked to Mark, and he didn't have too much really to offer in the way of ideas for small companies. And we would talk and we would talk, and finally came to the conclusion that if you demand from your small companies the same things that you demand from your large companies, you stand a really good chance of finding small companies that become excellent mid-sized companies and become excellent large companies. But you have to demand that high quality. It seemed to dovetail really nicely with Mark's work on quality. It seemed to make sense as far as George Nicholson's philosophies were concerned. And so we started looking for these up, straight, and parallels. This is a small, medium, and large up here example at the top. And this is actually what we're looking for. Yeah.
Those are actually all small.
Well, I was going to say this is a small, medium, and large, but it could be 3 large or it could be 3 small. And you don't really know what they are until we tell you what they are, but they're all high quality because of the consistency of those lines. Those nice straight lines on a stock selection guide, when you see those along with 4, 5, 6 or more years of history, I think you begin to say to yourself, I have a winner. And when you can say I have a winner, then you have the beginnings of a list that you can choose real investments from.
Now, what that doesn't tell you is what can happen in any one year. And we keep track of this from Halloween to Halloween. So you see last Halloween to basically yesterday. And the stock market went down about 17% since last Halloween. And the companies that we picked 1 year ago actually checked in at about minus 30. So for the first time in a long time, we actually came up short. Here's a look at the longer track record, and it actually goes back a little bit further than that. I've not ever gone back and dug back into the iClub list days before that, but you can see this is Forbes was actually doing that thing that Ken was talking about up through 2014, and that's when Ken and I basically began applying the Nicholson doctrine of, basically demand the quality in these smaller companies, and that's what the last 7 years represent on there, 8 years now. But even including that entire time frame, you're basically talking about approximately 14% for the stocks that have been featured versus 10% for the market. So that's a noteworthy difference.
We have a question from Cheryl. She wants to know, did I say that small represented companies less than $1 billion? When we started talking about this, Cheryl, they were actually smaller than that. You need to recognize that inflation, and I know that it's a topic that all of us are tired of dealing with in the front of our head, but inflation will change that boundary between small company and medium-sized company, and so you have to keep kind of adjusting that. I didn't want to step on our own toes, but I think for this year we've defined small as anything less than 2 billion in sales, and we have a special definition for asset-based companies that we'll talk about when we get there.
Yeah, and we still place as much or more emphasis on the growth rate as that primary indicator.
Absolutely.
So here's our 7-year winning streak that we were in seventh heaven a year ago, and this year is it's pretty obvious one of those is different than the rest. And
I keep telling you, Mark, it's like this because you brought it up every week.
Yeah, I am a little worried about that. But yeah, I think the market does what it wants to, no matter what I do. But I'm still a believer. We're gonna get back. We're gonna get back on the pumpkin. And this is not bad. This is. I'm still proud of that, even though we're bruised and a little more humble. And we'll just keep pressing on. All right, here's the actual specific culprits listed from best performer to weakest performer. The one that is highlighted was actually acquired in July, Sharps Compliance. So that was actually taken private or acquired back in that time frame. So that's basically locked in. But you can see in fact, I had to change the toner, the red ink toner, a couple times while printing this stuff. There's quite a bit of red ink there. There's quite a bit of red ink everywhere in the market for the last year. That's not exactly news, but some of these were quite special. All right. And here's our annual moment of silence, which we incorporated a couple years ago and we continue to do now. Cantel Medical had disappointed us for 3 years in a row, and we allowed our emotions to get in the way of featuring it again when it seemed like it should have been featured again, and we sat out the best and only good year of the 4. So the message here, there's many messages that kind of royal here, but be careful with the emotions, especially when
and Mark,
close track.
It's not only emotions from my point of view, at least. It's reminding yourself that we're in a 1-year contest also.
Mm-hmm.
Those 3 red numbers, if this is a long-term holding, those 3 years of negative returns really impact my psyche if this is a long-term holding. But if this is a 1-year contest and I'm starting fresh in 2021, why not start fresh with a clean slate? And if you like the company and if everything looks good, why not put it on there? It would have certainly given us a pretty decent relative return to add to the companies we already had on the list.
Yeah, and I think this is also a tribute to many of us. Maybe it's just me. If I have a stock which greatly disappoints me and I get rid of it from my portfolio, a lot of times I don't even want to check the price after I sell it.
You hold up 2 fingers in the form of a cross and say, go away.
That does happen. All right, so here's an attempt to kind of go to school a little bit on where may we have gone astray a little bit. This is that same list, ranked from best performing stock, Ensign Group, down to weakest performing stock, eHealth. And I added 2 columns to the right-hand side here. Now, again, this is just kind of an instinct or a gut check. I went back and I looked at the 2022 forecast for sales and compared it to the 21 actual for all of these companies, okay? So again, keep in mind, we're shopping amongst the smaller companies. We're looking at companies that are at a minimum-ish 12% growth rate or more. And this one kind of jumps off. Fulgent was actually benefiting quite mightily from COVID. They were preparing COVID stuff. I can't even tell you exactly what, but COVID stuff. So they were actually already projecting that the sales were going to drop off the table during the period of this contest. So, again, not picking on anybody. I don't even know whose idea it was. That's
obviously it was probably yours, Mark. So I mean,
could be. So, but that probably is an issue if you believe that the stock price is going to follow something like that. So looking at that, some of those are a little bit weird, but then taking a look at the analyst consensus, again, this is ACE, analyst consensus estimates for 1 year. Again, the time on this data is last Halloween. It's a year ago. Analyst consensus estimates, right? And the thing that kind of jumps off at me, well, first of all, these are pretty weak. So did the analysts see something that, that troubled them greatly about Axos and iRobot back a year ago? But what really jumps off the page to me, and this is in the full spirit of the World Series, is swinging for home runs or being effusively optimistic. And I think it's a danger Will Robinson moment. How's that for a Lost in Space reference? All of these huge numbers, just suggest that maybe there could be something wrong. So maybe we factor that into our thinking a little bit. What are your thoughts on this, big guy?
It's the bottom of the list, so that certainly, I think, says something, that the bottom of the list is so much more robust than the top of the list. And of course, if your eye is drawn to Sharps, remember, Sharps is a special case. It was acquired, and so that throws the numbers all out of whack when a company is acquired by another company. So kind of ignore that one and look at the top of the list and compare just the magnitude of the numbers of the top 6 or 7 with the bottom 6 or 7. I think Mark's right. It's maybe a swinging for the fence kind of thing. I want to explain that column, the one before the end, that Mark went over again in a different way for you folks that need to think about the numbers a little bit before they make sense. I want you to imagine a company that made $50 million in 2021. And it's estimated to make $55 million in 2022. Well, it grew 5 million from year to year, and 5 million out of the 50 that it was making in the old year is about a 10% number. I think that's kind of where these numbers are coming from, and it's exactly what we're talking about. It's just how much did the sales forecast grow from the 1 year to the next year? And that red obviously means that the analysts are thinking that it's going in the other direction. A good number in my mind for a small company should be double digits. But in this bear market, maybe we can back that off to something around 8 or better rather than 10 or 11 or 12 or better. What do you think, Mark?
Yeah, so in summary, when I'm looking at those 2 columns, what I'm actually just kind of looking for in my head is anything that's, think of it as plus or minus 1 sigma or 2 sigmas. If the number's way too low or way too high, it becomes suspect. And one last moment, we'll actually look at Sharps compliance here in a minute. The business model and everything for this company did look extremely good. The stock price actually did drop down to almost $2 before it was taken out at $8.75. So kind of an interesting case. But again, just this notion of swinging for the fences, and also we know it with PEs, we know it with other things when we see it. When things get too far out of what is a fairly normal or typical range, it's just something to be careful with.
Absolutely.
All right. This is a slide from last year. I had to leave this one in here because I don't know, Ken, if you knew that the tanks were going to roll into Ukraine or not.
No, I had no special knowledge, Mark.
No
No
special
knowledge
So
of anything. Just
I put this one up there, and I got one of these from Ken because he basically is blocking it on the grounds that it's just no earnings. The sales look good if we can believe the numbers, but I want to thank you for the red card, Ken. This would have been locked in within a couple of months at an 80% loss because this stock price is actually frozen by the Russian stock market right now at minus 80. So thank you.
last year I red carded anything from a communist country. So and I'm not going to go into the argument about what kind of democracy Russia is running right now. So we'll leave it at that.
Well, here's our worst performing selection. It was mine. He actually yellow carded this one too. I really like the theme. The healthcare digital theme, and this is a company that's been in there for a couple of years, but this again is the type of company that if it actually stumbles and goes negative, which it basically did, and Ken just hates this chart down here. We shouldn't be investing in that. It's the type of company that a lot can go wrong very quickly, especially if it dips back below zero when it comes to earnings. And this is about let's look at the number. I can't bear to look. 94% loss. So that's all I need to say about that.
Well, I always get a little bit fearful when I see people from my generation smiling and laughing over a tablet screen or a computer screen. My experience is when they write programs for us older folks, they use us as test dummies, I think. I'm not sure. Natalie and I are both very computer literate, and it took us 2 days recently. The federal government changed withholding laws on pensions, and you used to be able to just designate what you wanted to have the IRS take from your pension, and now you have to designate just like you do on a regular W-2, and then you can add to it a dollar amount if you wish to. In order to get to the Michigan.gov. Michigan Pension System website, it took us 2 full days and probably 2.5 hours on the phone before we finally got to Earl that admitted the website sucked. I mean, this is the help desk admitting that, and then taking us through back doors to get to the place where we could finally make the changes. So our tip off should have been the 2 smiling baby boomers up in the corner there, Mark.
And you picked on them a year ago too, and pointed out the danger sign there. But I think the way I would boil down what I just heard you say is there is a market for somebody to get that right. And
absolutely, yeah.
And so that leads us to our top performer, Ensign Group, which is in kind of a related area. I mean, all the stuff that they do up here at the top that deals with a variety of different forms of healthcare and stuff. It's a completely different environment, and they're getting it right. So
this is mainly bricks and mortar. We should be real clear, Mark. The Ensign Group is mainly bricks and mortar, owning places where you can get help for your ills, whatever they happen to be. Also, some urgent care kind of things that Ensign Group operates. But it's a well-run operation, and the relative return from this company points out that it's a well-run operation, I think.
Yeah, it's got a good long-term track record. I mean, that's one of those charts that looks pretty good. And last but not least, here's that one that actually did the real boomerang. And again, it is the type of picture that's quite compelling. It's a company that has a pretty good chart on the right. This is early stage growth, so you're going to have stuff like this, but they seem to be headed in the right direction. Very high expectations a year ago. All of this is in the right direction too, so ultimately worked out, but it didn't do very well for us. When it came to the actively managed part, we're just going to cover this real quickly. We also, for the first time, actually had an actively managed alternative to the passive portfolio, the traditional portfolio. The ones in yellow are positions that we closed out and replaced with other things. And we've been kind of hard on ourselves when it comes to this, but I think we made some pretty good choices along the way. In mode, that energy company, Pachira is up there. There's just some pretty good choices up there. There are a couple that didn't work out very well, one of them being Ranpak. But in the case of eHealth, following our selling discipline, we got out at basically a pretty small loss compared to minus 94%. So, and we got out of the China hospitality company at a pretty decent place too. So, kind of mixed results. The problem ran into the fact that we sold out of Sharp's compliance near its low, and in less than a month later, it sold for $8.75. So that would have made quite a difference for us. And here's a look at this.
Yeah, I do think, Mark, that we might have been a little bit too early when we jumped on Essent and Merchants both. I think that I think we might have been a little bit too early jumping on them there. Or maybe we shouldn't have jumped on them at all. Maybe that was it.
Yeah, well, where did Essent end up? Essent actually ended up a couple of dollars lower. Yeah, 39. So it didn't go anywhere after that.
Well, Essent ends up with a positive relative return, though.
Yeah. Essent.
Yeah.
Essent did, yeah.
Essent.
Mm-hmm.
Yeah.
All right, so here's the comparison. Again, this is just a reminder, again, that October to remember, put a lot of green on this chart, with one of the best years since 1976. We actually were ahead of this the entire year until October. That's the Russell 2000 Growth ETF. And you can see the performance of the two portfolios. This is the one that we'll keep track of. You can see I was trying to bring them out of their grumpiness midsummer. That was on the trip to Dallas. But that's where we ended up. So we'll quit licking our wounds and go on and press on.
Well, let's look at the new list, Mark.
All right, here's your reminder of where we find red rabbits. Again, we love doing it at this time of year. The Motley Fool, small company stuff that's out there. This is Kathy Wood in the middle of the chart. Morningstar, I find lots of ideas inside the mutual funds at Morningstar. We've demonstrated that at bull sessions. We do screen NY charts. This is Chris Jenner from Rock Springs Capital for technology medical stocks, and then some of our favorite lists and tools for finding stuff. Kevin Gologly actually sent us a full copy of the Hoover's Handbook a few days ago. He cost me a few hours of sifting through those pages, enjoying every minute of it. What's your favorite source, Ken?
I still like my lists, Mark. I like as many lists as I can find, and to be honest, I found InMode, and I've found another 2 or 3 really good ones using the SSG Plus and the small company preset screen. I continue to find 1 or 2 ideas that are so new that they've just entered the Morningstar database, and we want to catch them in the Manifest database. So I'm a big fan of running that screen. It only has 8 or 9 companies that come up on it most of the time, but I run it every couple of weeks, and lo and behold, if there isn't a new stock on it on a fairly regular basis,
Absolutely. And Marie Frank, this one actually came out a couple days ago, and went through it. Nothing really qualified for the list that we're talking about, but good ideas, but they came out a little too late to really do much with during bull sessions this year. All right, so here's a reminder of what we're looking for. As Ken talked about earlier, we are looking for up, straight, and parallel as best we can, as much track record as possible. Quality does still matter. We do like to see a sales growth forecast greater than 12. As far as a guideline that would be similar to the Better Investing guideline, again, adjusted for inflation. Ken said 2 earlier. I jumped this up to 2.5 just to stay consistent with Hoover's definition. So annual revenues of 2 or 2.5 billion maximum. And here's that number I was telling you about earlier, Ken. If you actually do a screen that looks for how many companies actually fit that description, this is the percentage of the total number of companies. I'd say that's a fairly decent percentage for, small companies in the universe of all companies. So I'm kind of comfortable with that.
So if we were doing even Steven, that number would be as high as 32, 33 then. So yeah, that's actually cutting out fewer than I expected. Okay.
Okay, so again, we give some latitude on all of these. Forbes tended to have some fairly rigid rules, including they wouldn't put banks and insurance companies in here. And we do try to keep the companies bigger than 10 million, no penny stocks, greater than 5. And we do like the asset-based companies that have been crucial to our success here over the last few years. Brown Small Company Mutual Fund is an example of a company who completely eschews the financial sector, and they've paid the price the last couple of years. If you want to do a quick case study, take a look at Brown, the mutual fund, Brown Capital Small Company. And Ken just wants to reinforce that we do watch the size of a financial or asset-based company, trying to keep the total assets under 10 billion. It's kind of a break point. Anything else there, sir?
Nope, that looks good.
All right, let's go to work. This is the companies that we ended up with, and we're going to actually sequence through all of these as this year's list. So I'm going to kick this off with Walker and Dunlop. It's a company I was not familiar with until a few years ago. You may remember when we had the national meeting in Chantilly, Virginia. It's been a few years ago. At the same time, the Motley Fool was running their national conference, so I was actually hopping between the two conferences. I actually met Wally Walker at that conference and at the Motley Fool conference, and became aware of them. It's a Tom Gardner favorite. They are a lender. They basically do concentrate more on multifamily and commercial real estate. But what I'm drawn to is just simply the long, steady track record. A little bit of a reduction in margins in the last couple of years. That's a product mix with more commercial and industrial. A little bit lower margins, nothing to get too upset about. But these guys basically position themselves in the entire mix of that entire real estate market, down to all of the pieces, the technology, the financial services, the real estate services, down to doing appraisals and all that kind of stuff. So good track record, good long-term Tom Gardner favorite. Seems to be good people, and I just love the Brene Brown quote at the bottom. I feel pretty vulnerable when I'm talking about making a pick like this, considering the interest rate market today. And the empty commercial real estate that I see in this area that's still sitting vacant. But if anybody can do it, these guys can. And, there have been trials and tribulations all through that track record, and they have won despite that. So any comment on that, Ken, or should we press on?
Well, it does back up one of the companies that we've had in our roundtable off and on over the years, and that's CBRE.
Absolutely.
So they're all tied together right there, with Walker and Dunlop in the sweet spot between all of those different names. There's Rocket Mortgage there, and of course Wells Fargo and some of the big banks. So a very interesting choice for our first choice.
Yeah, these guys may be small, but they've got some big friends. All right.
Well, the first one that I'm putting on the list is a repeat from the last couple of years. Last year, it delivered a negative relative return, but it was in single digits, negative 8.3%. It's also a 4-time roundtable selection. We have it in our roundtable portfolio. You can see the lines reasonably up, reasonably straight, reasonably parallel. And when I do what I consider to be a pretty conservative SSD, I get a nice buy for Malibu Boats. Malibu Boats is very R&D forward. They like to stay out in front of their competition. So they're always looking for ways to add things to their boats that could then be sold in the aftermarket to other people with other brands of boats. And then eventually they become standard and they end up on lots of boats, not just the Malibu branded boats. Malibu has a lot of brands of boats, a lot of different price points. It's usually considered a premium brand, however, and the company is quite secure in its niche. It's the biggest a premium boat builder. Like I said, real heavy on research and development, and moving into a lot of newer areas as people begin to do more things on the water with their watercraft other than just float around and cruise. So I happen to believe that there's a significant portion of the country that don't write me lots of emails now, okay? But I think there's a significant portion of the country that's not as impacted with inflation as a lot of folks are. There are a lot of people in my generation that don't have mortgages, that don't participate to any great extent in the housing market, whose food bills are relatively modest and stay fairly modest, and who have a lot of discretionary income to spend on grandkids or to spend on travel or to spend on whatever they would choose to spend it on. And I think there's a lot of people in my generation that are spending it on boats. They'd like to be on the water. They'd like to have something that they can share with their families, and that includes their extended families, their kids and their grandkids. And I don't think that you're going to see significant downward drifts in sales or earnings. I think they might slow down from the rate that they're at. And I know that it's difficult to read these numbers on this slide here, but in the last quarter, Malibu Boat sales grew by over 20% and its earnings grew by over 40%. So while I do anticipate some slowing, I don't think it's going to turn around into a disaster. And the history that I see there indicates to me that even if we do have a year where earnings move slightly downward, they tend to have a nice rebound the year after. I'm sorry if I happen to pick a down year, Mark, but I'm going to keep it on our list. It's been a good performer for us for a while, and let's see what it does this coming year.
Well, if you want to feel some, exercise some of that nostalgia, you can help me with my next mortgage payment.
Okay.
Okay. Our third company is Semler Scientific. This is one that we have talked about in a few roundtables over the time in the successful investing conference over the last couple of years. This is basically cardiac testing at your kitchen table. And the tools are shown right there along with some of the stuff that they're going after. Pretty interesting company. It kind of reminds me a little bit of the early days of Masimo. You may recall we were on that one fairly early with the oxygen sensor that was quicker to catch problems with infants and hospitalized patients, that sort of thing. Well, this is kind of the same thing. Fairly decent sized market. They are fairly well patent protected, but there will be competition. But you can see in the graphics on the right, a fairly strong track record, fairly decent profitability, and no debt, pretty good amount of cash, and pretty decent return forecasts. All right, your next one, Ken. Yeah, you're on the bandwagon here. Going to continue to ride this.
This is magic as far as I'm concerned. If any of what I say in the next 2 minutes really interests you, go to the InMode company website and search out the investor presentation. That slide in the bottom left is the cover of the investor presentation that says InMode with that dark background, and look at some of the pictures of what some of their tools are doing for people. This is next stage vanity plastic surgery, I guess is the way you kind of title it. And they've also moved into women's health issues. They've discovered that a lot of these tools can also be used to greatly improve women's health. They're all minimally invasive. You can see the use of the Morpheus tool on this woman from the before picture to the after picture, and they'll just blow your mind. It's almost like somebody waved a wand and the person lost 10, 15, 20 years. I was especially intrigued by the things that they did with men and women about bringing the chin line back, about taking the flesh that gathers underneath your chin and making that kind of basically disappear. They talk seriously about a new phase in plastic surgery, a new direction, and this whole idea of it being minimally invasive and much longer lasting than any other previous ablative aesthetic surgery really plays to my mind. InMode was our best performer from last year. And if you look at the dots that I've projected, those are Morningstar numbers. I'm projecting pretty vigorous growth, and Morningstar is suggesting that that growth is pretty realistic, at least for the next couple of years. That's growth in the high teens, low 20s right there that I'm projecting. So take a look at InMode, INMD. Last year, a 50.3% relative return to the market, and everything looks in place for it to continue its move upward there, including the fact that the price is less than half of the top price in the last year. Go on, Mark.
Yeah, it's actually come back quite a bit. I just
Yeah.
also have to wonder if this isn't, we've talked about the theme of the return to deferred medical procedures, medical and dental and elective. And this certainly fits that theme pretty well. You know,
Right.
some of that Malibu money actually might end up here.
Well, and if you can't move into a new house, maybe you put some of that money into a new skin. You know, I don't know.
Okay. My next stack is one that is probably well known to many people in the audience. Yeti Holdings, ticker is YETI. And yes, that is a bear unsuccessfully trying to break into a Yeti cooler on the upper left. I figured that might give us a little bit of a push into our new year with the pumpkin. This company is no stranger. Coolers, water bottles, all the products are shown there in the illustration across the middle of the page there. Everybody I know has some of this product, and I know that my wife actually contributes or donates them all over town, and we end up replacing them. So there is a market to be made even with existing customers in the replacement zone. But you're talking about a company with about 20% return forecasts, up straight and parallel. The price has come back fairly substantially from the peak back in 2021. Decent profitability. Just a whole lot going for this company. I actually owned this shortly after the IPO. I wish I still owned those shares. I may be going back. And now
Uh,
we made it 6 companies in without getting to a bank. Here we go.
have to go with a bank, and this is a very small bank. The asset base for this bank is just about 7 uh, billion. So that's a pretty small asset base for any bank. This is in metropolitan New York. They are a pretty traditional bank. You can see the up, straight, and parallel. That extra line, that aqua colored line right beneath the green line is the assets and the growth in the assets. And you'd like to see that line roughly parallel with the sales line and the earnings line, which it is. And so I'm pleased about that. I pulled out a graph. The performance of this bank, Metropolitan Commercial Bank, MCB, the performance of this bank over the last 5 or 6 years is that dark blue on the graph. It's the highest one. The bottom one there is an index which is made up of all the peer group that Metropolitan Commercial Bank happens to be in. And the middle line is a performance of just 8 or 10 of the highest growth banks in that peer group. So Metropolitan really seems to come out on top. I really like to watch return on average assets. And for the last 4 years, they've been over 1. When they reach 1.25, that's a great bank. When they're over 1, that's very good. And the longer they can do this, the better off the bank happens to be. I think this is an excellent, very small bank which you can put some money into. Notice the tick mark on the I bar. Maybe Mark will circle it for us. It's trading near the bottom of its range. And that's typical for almost any bank you look at right now. As interest rates go up, banks are going to make more money. And as banks make more money, their prices will go up. I think this is a generational time for you to add a bank or two to your portfolio. And I would suggest taking a serious look at Metropolitan.
You don't know how bad I wanted to put the Mortimer brothers on this from Trading Places. All right, next stock is Gentherm. This is one that we featured last year. In fact, this is Ken's slide. This is keeping your cheeks warm, keeping your cheeks happy with cooling and heating of seats in cars for the most part. The company was formerly named Amerigon. It is a Michigan company, so it's right in our neck of the woods from Northville, Michigan. It's going to have industry cyclicality. That's why you see some bumpiness, but in general, it is up and to the right. So we do like that. So this was the slide from a year ago. Again, they principally make your cheeks happy. They do have a little bit of keeping your cheeks warm while you're in the hospital bed too going on, but mostly in vehicles. Here's a look at the company's business model fundamentals over time. Value Line thinks that the company's pretty timely right now with a fairly decent expectation. I noticed that the return forecast has rarely been higher. Improving quality, very consistent, especially for a company that's vulnerable to this type of economic cyclicality. This is pretty good. Pretty good performance. Pretty good that they are able to maintain margins in such a consistent zone also. So you can have pretty good faith in a lot of the numbers top to bottom here. A little bit less frisky, a little bit less sexy. Returns in that 12 to 15% range, but after doing minus 30 this year, I think 12 to 15 sounds pretty good to me, Ken.
Me too.
Oh, and here we go. You stuck on this one. Now, do you know the CEO of this company, or do you?
No, I don't know him or her.
Relationship going on here.
This is Fox Factory. I've presented this company 2 or 3 times at the roundtable already. You can get a much more in-depth presentation if you look up the roundtables and find out when I presented Fox Factory. But these folks operate in 2 divisions, the specialty sports division and the powered vehicles division. You can see the business is split pretty evenly, 50-50, and in the most recent quarter, 55 in the powered vehicles and 45% in the specialty sports. Notice the growth rates; they're fantastic. That's 27% compounded annual growth rate over the last 3 years for that company in these two different divisions. What they make pieces for the person that isn't a pro sports player but would love to be a pro sports player. They focus a lot on bicycles, on things that you can power by yourself. They make the state-of-the-art, I don't know what that's called, a tongue maybe, but that piece
Fork.
right there goes on a bicycle, a fork. Thank you, Mark. And they make the state-of-the-art fork for if you're going to race in bikes, then this is the fork that you have on your bike. They also make a lot of pieces. They make very, very lightweight wheels. And then in their powered vehicles, they add a lot of different components to original equipment. You can see all the different brands up there. Almost any brand that you can think of that does something off-road is up on that original equipment list. And then they have a lot of aftermarket brands that they sell that you can add to a vehicle that might not be on this customer list right here. All in all, again, I think generally that this has a market that's fairly immune to what's going to go down. They have the ability to raise price. So if inflation does stick around for another year or a year and a half, Fox can keep its inventories moving with a price raise. You're passionate when you own these kind of pieces for your equipment or this type of equipment. You're passionate about it and you spend the money for your passion. And the kinds of people that are doing these activities, again, I think have some money in order to deal with their hobbies. I like Fox Factory, FOXF.
Cool. And that's a shameless self-familial promotion. My wife works for Jeep. So
Okay.
good for them. All right. Here's an interesting one that Ken brought to my attention as we were going through this exercise. This one's a little bit earlier stage, but it's certainly a pretty solid work in progress. The name of the company is MP, as in Mark Pedro Materials. It's the largest producer of rare earth materials in the Western Hemisphere. And specifically, they make stuff that is in some fairly key components of vehicles, whether it's an internal combustion engine or an electric vehicle. And you can see here they're basically telling you that the amount of this stuff, these rare earth metals, goes up by a factor of 7 when you start switching to an electric vehicle. And so these guys are in their leverage pretty good. It's always fun to have a company headquartered in Las Vegas. But the key component here happens to be these type of magnets. I can't even pronounce the metals that are involved here, but these magnets are involved in a whole bunch of different motors. Could be early, could be bumpy. It looks a little bit flat, but when you really get into their materials and review, Ken and I both believe that they are not, that these numbers here are not fully reflecting their current expansion plan, which is well underway. It's actually ahead of schedule, and we actually expect the numbers on the right-hand side of this chart to probably deflect up, so that's a bit of a catalyst going forward. So again, decent returns and a little bit earlier stage than some of the other companies, but probably not as much into that realm as we were a year ago. Okay, anything else you want to add to that one, Ken?
No, except that I'm very excited about this this company. I think that it's the kind of thing that this country has to do to get itself back and remain competitive in the world. So I'm glad to see that we have somebody moving in that direction. And I'm glad to see the percentage of materials coming from this. About 15% of the materials consumed worldwide are coming from this one place.
Mm-hmm.
So that's a pretty decent percentage to start with.
Yep. There's pretty good stuff going on there. Okay, a little bit more technology here.
This is Technoglass. That's a modern city. I'll let you decide what city it is. But look at all the glass, and most of the glass in this lower picture in the lower right-hand corner here is made by Technoglass. Technoglass is the world's leading supplier of architectural glass to the U.S. and to Latin America. You'll notice that it does a lot of its work in Florida, one of the fastest growing states in the nation. And it also has a lot of business in Texas and then way up in Maine and Massachusetts as well. The darker the blue on the US map, the more glass is going into that place. When I was in Texas recently, I was amazed at the number of cranes that you could see on the horizon, the building that's going on in some of these states that are attracting people on a huge basis. I was glad to see Tennessee is one of the places where Technoglass is operating. I just watched a program about Nashville. Nashville's gaining more than 100 people to live in the city every single day. There's more than 100 people move in to add to the population of Nashville, another place that's growing by leaps and bounds. And modern architecture uses a lot of glass. So I'd take it there. I put in a circle graph there of the breakdown of the kinds of glass that they're using. And you can see that there's three major types of glass. The total U.S. addressable market is more than 32 billion. And right now, Technoglass is in the top 5 in providing that kind of glass. They operate in 6 different brands, and those brands are listed up there. I doubt, unless you're an architect, that you'd be familiar with the brands themselves.
Mm-hmm.
But just the fact that when you look at a modern skyline, you see building after building after building that looks to be, half glass or 3/4 glass or all glass. This product obviously has to be something that we should be paying attention to as a building product. And there's a lot of building going on right now. If we don't live in some of the high build states, maybe we're not aware of it, but believe it or not, you go to Florida, you go to Texas, you go to a couple other states, South Carolina is another one, and all you do is see building going on everywhere.
Is that city
So,
Austin, Texas?
this happens to be Miami.
Oh, really?
Yes.
The other question I have, just a real quick question. This one in the middle that I've highlighted, are those electricity producing windows? You know?
Yes.
Cool.
Yeah.
Gentex is working on that too. I'm fascinated by that. All right. I assume you're done.
I'm done.
All right. Here's a slide which has been appearing in a number of roundtables. Since the selection of Portillo's 4 or 5 months ago, it is the top performing selection at the roundtable. Just like to point that out. All right. This one does not have a lot of publicly traded history. It is a company that's 40 or 50 years old. So it does have some experience doing this kind of stuff. They make exactly what you see here, but it is kind of and because Matt hasn't brought us, was it Torchy's was supposed to be coming out pretty soon? We don't have an IPO on Torchy's to pay attention to, so this one is pretty good. It comes out of Chicago. It is spreading out a little bit. It's got lots of room for geographic expansion. They don't just make hot dogs. They have all kinds of other sandwiches and salads and stuff like that. And this is just a little bit of a flyer. One of the other reasons I bring this one is we've talked about this from time to time. We have a real hard time with the retail and restaurant stocks in many of our portfolios. And Ken and I have lamented the fact that companies like Popeyes a few years ago, what was one of the other ones, Wingstop, Chicken Wings, and a couple others like that over the 17 years of the best small companies, it's not uncommon to have one of these companies actually end up at the top of the list. And I guess I'm a
Texas
little bit.
Roadhouse.
Texas
Yeah,
Roadhouse,
Texas
another one.
Roadhouse.
Yeah, Texas Roadhouse. So again, that can happen. Just allowing it to happen, and I'm a little bit inspired by McDonald's being at an all-time high with its stock price. All right, next one, Monolithic.
This is Monolithic Power Systems. I've wanted to own this company for a long time. It's been on my wish list. I have a caution down at the bottom right-hand corner that this is still a very high PE stock. I think the PE when I prepared the slide today was still the current PE around 41. But the kind of growth that the company is exhibiting, I think might in fact warrant a PE into the high 30s, low 40s. The PEs have gotten astronomical at various times in the last 5 years, but you can certainly see the consistency of the growth and the earnings and the net profit from that graph that I captured over there. Again, I don't know if you can read those quarterly figures, but sales have increased dramatically, as have earnings, and those are both numbers over 50%.
53.78, yeah.
Yeah, so this is dramatic sales increases. I used PEs of 40 for the average high going forward and 25 for the average low. I still got this to move into the buy zone. Notice that again, the tick up at the top there, I'm looking at a stock that's trading near the bottom of its 52-week range right now. And that is the kind of stock that I'd love to be able to stumble into at near the end of a bear market. I'm not concerned about picking the absolute low. I'm just concerned about getting it somewhere near its low. What I also like about this company is that 40% of its cash goes back to shareholders in the form of dividend and stock buyback. That's 40% of their capital is being returned to shareholders. There's a difference there you can see on that graph between what Monolithic is doing and what the average company is doing. That car picture right there is just showing some of the different places on a new car. And this is not even an electric car. This is a standard engine car, a standard gasoline engine car. And you can see the places where they need power. They need something to control how much power is going to some of these different sensors and some of these different fuses and everything. I don't know, count the dots. There's more than 20 in my estimation there. And Monolithic is providing a lot of that technology, and they're providing it in all kinds of industries. I just chose at random the megawatt battery storage. When you have these wind farms or these solar farms, you need somewhere to store the power a lot of times. You can't feed it directly into the power grid. So you need places to store the battery thing. They not only make battery storage for these large applications, they make battery storage for a home application as well. People that have solar panels on their roof, for example, probably are generating during certain times of the day more energy than they need, and you have to store that somewhere. Again, I'm always telling you to go to the website, look at the presentation, the investor presentation. This company does more things than you'll ever be able to remember. They have a half dozen different divisions, and every division probably has 15 or 18 major products. They are just so diversified that you can't cover it in a single slide or two slides. They don't do a lot of the creation of the product themselves, but they work with partners in third chip foundries, and they and in those foundries they make their proprietary chips then. Just a real revolutionary kind of company, selling at a really great price, but caution, it's still a high PE stock. Nobody seems to think that it's going to slow down, however. So there it is. It's not following the normal pattern that the chip stocks follow, the up and down cyclicality of most chip makers. This is generally moving in a single direction. So take a look at it.
Probably a lot of product diversification there is helping quite a bit.
Yep.
All right, so everybody, Ken and I have both chosen 6 stocks at this point, and he's just dying to pick another bank, and he says, "Well, Mark, why don't you go ahead and take the next one?" And the ticker's SFBS, and so this is the way he got around not picking 3 financial companies himself. He basically handed off to me and let me do it. This is an interesting bank. They're headquartered in Birmingham, Alabama, but the graph basically says it all in terms, I think of it almost as a green brick type story. These guys are, you say Tampa, Charleston, Atlanta, Nashville, you are in kind of the zone for, rapid growth in this country, and some fairly successful companies have their eyes on this turf, including these guys. And you can see the book value basically sets your watch to it. The return on equity is strong. And then Ken's favorite, Ken, be still your beating heart, right? I mean, wow. That's return on assets. It's not necessarily return on average assets, but it's close enough. That's in the excellent zone for a company like this, and it's been there for a while. So good stuff. Not quite as flashy a return. Again, you can get a little bit more out of it, but just a real nice leveraged bank in a real nice field of opportunity where they're at. So anything else you'd like to kick in on that?
Yeah, and not typically for a small bank, Mark. This one's actually paying a fairly decent dividend as well. It's paying 1.5 yield. That's not a real common thing for these smaller banks. So to find a nice dividend is just gravy on the, or a cherry on top, I guess, on the sundae of the bank.
Yep, pretty good picture. So there you have it, folks. Those are the stocks that we will be tracking over the next year. We probably, despite the fact that Ken thinks we jinxed ourselves, we probably will still track them, and probably add a little bit of a tracking element to it in the bull sessions as we go. Maybe not every week, but check in on them fairly regularly.
I'm going to answer a question, Mark, that comes from 3 or 4 different people, if you'll stay on that slide.
Okay.
Those asterisks, folks, don't mean anything except for the fact that the company is not represented in the standard value line. That's all it means. They're not represented in the standard value line. So those companies that don't have the asterisk are, and those that do have the asterisk aren't. That's all the asterisk means.
It's actually fairly noteworthy that we have 6 that are in the standard edition.
Yeah, Value Line is doing a nicer job, in my estimation, Mark, of coming up with some more early stage companies and putting them in the standard edition if they seem to have a lot of if they seem to be moving in an area that might be helping the general economy to a great extent. So I'm kind of pleased with that. I was surprised, for example, to see MP in the standard value line.
Me too.
Yeah.
All right. Any other questions or comments?
No, but I have some hands in the air. So Jennifer, I can't unmute you, Jennifer. You'll have to unmute yourself. But if you unmute yourself, you can ask your question. Jennifer Adair. And we're going to assume that's an inadvertent hand, and we're going to take that down. Let's see if we have any other questions right here, okay? Teresa wants to know how many bank stocks do you put in a general portfolio? For me, Teresa, I like to keep my holdings in banks somewhere between 8 and maybe 12 or 15%. Bank stocks are a pretty decent size of a lot of the indexes we look at. Mark, do you have any figures on that?
Well, I will. Well, yeah, they run around 20% of all companies. The other thing that I would point out is in that Fortune fastest growing company list that just came out, that's 100 companies, and I think 30 of them were regional banks.
Okay.
There's a message there somewhere.
Patricia says, shall I sell my 22 small caps and buy these? I think that maybe you want to communicate with Mark if you've moved into that. Mark, what's the name of the broker that you were using at the beginning of last year to develop that?
We should probably spend a moment on that. I'm kind of disappointed that didn't work out as well as I had hoped it would. Obviously, anybody here is welcome to do your own homework, make your own decisions, and cherry pick some of these or all of them if that's the type of investing you want to do. You know, when we did it last year with the 20 companies, it really does add something which, you know, many people don't want to add 20 companies to their portfolio. So, you know, with the tax reporting and all that kind of stuff, what I would really hope to do at some point is maybe simulate an ETF, you know, basically have a single point opportunity to invest in these type of companies, maybe through a First Trust managed account or something. We're not in position to do that yet. I'm not going to do the M1 stuff again. I found their stuff to be a little bit disappointing. That's as far as I'll go.
Okay.
So
Jane Johnson. Oh, I'm sorry. Go finish up, Mark.
I'm done.
Jane Johnson would like to know, will this list be on the Manifest Investing website? Yeah, it'll be there somewhere, probably in our list of dashboards that are public. We'll probably put up a list that's labeled Best Small Companies 2022 and give it a day or so, but I assume it'll show up there pretty evenly.
It'll be there.
Cheryl wants to know, are we going to actively manage this list? And right now, Cheryl, we're suggesting we're going to do exactly as we did last year. We will show the list as if we never touched it at the end of the year, but we'll also look at actively managing it and see what the difference is between. It's kind of a work in progress. There were times during the year when we thought that it was not really doing us any good to actively management. There were times when we were very excited about the active management. So I still think that it'll take another couple of years for us to decide whether it's a good idea or not. Okay. I'm looking at other questions. Ken would like to know, Mark, is Technoglass being added to the Manifest database?
It has been added, so it'll show up within the next few days.
Okay.
For dashboards.
And Jennifer would like to know about Technoglass. Jennifer, this is not a stock study. So when we present Technoglass, it's just an idea for you to study and for you to get into. So no, we're not talking about numbers that may or may not include hurricane or storm rebuilding. And we're not talking about whether this glass is covered by commercial insurance or not. I would imagine that the answer to that question would be extremely complicated, and it would go building by building
It
as
would
to
be
what is
very
covered and
location
what
specific.
isn't covered. Yeah, so, but again, we're providing some ideas right now. And we're just looking for you to decide whether it's something you're interested in, and if you are, maybe you can tell us about things that we've good things that we missed, and maybe bad things that we miss as well. Susan would like to know, when I'm talking about Fox Factory, am I talking about bikes or bicycles or motorcycles when it says bikes? And Susan, they make parts for both, but they make parts in their different divisions. They have one division, which is that sporting division, and that's basically racing bicycles, self-powered bicycles, but they also have materials, different products that go onto motorcycles. You might have seen Indian Motorcycle or Harley Davidson as some of their customers. So they make parts for both regular self-powered bicycles and motorcycles. Fox Factory does. Susan says that she just heard that about 30% of small companies are unable to pay their rent. The only thing that I would say in response, Susan, is that in my experience, at least a third, maybe as much as 45 or 50% of small companies don't make any money. And that goes back to the first thing Mark and I said when we began to put these lists together, that you must demand of your small companies the same things that you demand of your large companies. And that means they have to be profitable. They have to have a business model that makes money and that covers their expenses. So we're not talking about small companies in general. We're talking about a very specific group of small companies. And Mark, what would you guess, that we started with maybe 40 or 45 names to whittle down?
We actually started with 116.
Okay,
We
a
whittled down.
lot more than I thought, but it's still a relatively small amount,
Yeah.
small number of the total small companies that are out there then.
And
Okay.
there are some companies out there, and Walker and Dunlop is probably among them, that are certainly seizing opportunity. I lamented and talked about empty office buildings and commercial real estate being quite a mystery. It's also a field of opportunity for those who figure out what to do with it. And that includes some of the companies that we know that are into strip mall ownership, and that type of thing, where some of the companies there, some of the stores are really struggling, but at the same time, there's people doing it very well also, and we certainly want to seek those out.
Dave King says that I emphasize growth rate for small caps. Are there other criteria that you use for other size companies? And Dave, when we're talking in the roundtable, we usually talk about large companies, and we talk about them growing at 7% or less. We talk about medium-sized companies, and we talk about them growing at somewhere between 7 and 12%. When I say growing, I mean growth in sales, and I'm not mentioning capitalization. We call them large or medium or small. And when we're looking at a company growing in excess of 12%, we tend to start out by defining it as a small company. And of course, there's wiggle room between those numbers. There are very large companies that are growing in excess of 9 or 10 or 11%, and there are a lot of small companies growing much slower than 7% or even 5%. So there's general ideas for growth for the size of the company, and we tend to use them in very general ways. Mark, I think I've covered all the questions. Do you have anything to add?
I do. Everybody out there should know that 95% of all pumpkins in the United States and worldwide come to you from Illinois.
All right.
And in fact, Ken, we were there a couple of years ago at this time of year. 80% of all pumpkins come from within a 90-mile radius around Peoria, Illinois. So
Oh,
they're
I should have known that, you know.
I mean, I grew up next to pumpkin fields, so I know this. And
Oh,
I just thought the audience should know that Illinois is the source of pumpkins.
well, there we go. There's an Illinois. This is the picture of an Illinois pumpkin now, right, Mark?
Well, there's a 95% chance, Ken.
Okay, great. All right.
And I think we're ready to
So,
get back on the pumpkin and hope for better performance from our best small companies for this year. So get out there,
we'll
study
keep
them, enjoy them, and help us keep track of them over the next year.
and we'll keep talking about them month in, month out. Don't worry. We're not going to forget about them in the next year. We'd love to see them do well. And right now, at the beginning of the year, everybody's real optimistic about the whole thing. So I have one more question that just came up. Bill Warner wants to know, Mark, if that's the great pumpkin or the son of the great pumpkin.
Yes.
Yes. Okay. So with that, we're going to say goodnight to everybody, and thanks for coming to this special edition roundtable. I had a really good time. Mark, I hope you did as well.
I just hope that we see green ink used more this year.
Good night, everybody.
Take care.